Good morning, ladies and gentlemen, and welcome to the Pressure Technologies PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time using the Q&A tab just situated on the right-hand corner of your screen. Please simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, we would like to submit the following poll, and I'm sure the company would be most grateful for your participation. And I'd now like to hand over to CEO Chris Walters. Good morning.
Good morning. Thank you, Mark. Thanks for the introduction. It's good to be back on the IMC platform, and good morning to everybody who's joined us today. I'm going to just first give an introduction to the presentation today. We've got an introduction to the group for those less familiar with the company. Some group highlights from our interim results presentation 2022. James will talk in a bit more detail about those financial results, and then we'll look specifically at the two operating divisions of Chesterfield Special Cylinders and PMC, looking at their divisional highlights, followed by an outlook and summary. So first of all, then, our group, and apologies for those who are more familiar with the group, but as an introduction, our focus in Pressure Technologies is to realise value from our two core manufacturing divisions of Chesterfield Special Cylinders and Precision Machine Components. We launched in 2019, in June 2019, just 3 years ago, our growth strategy for those two divisions. At the same time, we executed the divestments of non-core operations. Our focus was the scale and growth and diversification of both divisions in core markets and extension into new markets. Chesterfield Special Cylinders is the cornerstone of Pressure Technologies, established back in 1897 in the manufacturing of safety critical gas containment systems. And we serve, as you can see in the bottom left-hand corner there, some very significant blue chip customers in defence, in industrial and oil and gas markets. We also have, not only alongside our cylinder product business, we have a growing inspection and recertification business for cylinders and pressure containment systems, and we have an exciting opportunity in the hydrogen energy market. We'll talk about in a bit more detail in the presentation today. In our precision machine components business, the Almet, Ruter and Martract brands are very much focused on safety critical applications for oil and gas production, drilling, exploration. We're also seeing, in addition to oil and gas market opportunities, new opportunities in defence and industrial markets. But our focus for the PMC division over the last 3 years has been the diversification and scaling of that operation across the blue chip customer base, as you can see there, the Schlumbergers, Halliburtons, Baker Hughes and so on. So that's an introduction. We'll talk then today about the results for the first half of this financial year for those two divisions and the outlook for them as well. So first slide for me here is the group highlights. Very much as you might expect, facing different markets, a mixed bag of results for the group, and heavily influenced by the contracts, the major defence contracts in Chesterfield Special Cylinders, where we see between month and month, quarter and quarter, and in this case half year, very significant differences in revenue depending on the milestones and the contract placement for those major contracts. In particular for Chesterfield Cylinders, whilst we have a very much lower level of activity in the first half of 2022, comparatively in 2021, the first half performance was very significantly positively impacted by contracts. So the contrast between 21 and 22 is really quite significant, and those revenues of 6.3 million compared to 11.3 million reflect that phasing of major defence contracts. Defence contracts for the likes of BAE Systems and Naval Group, Dreadnoughts, submarine programs and surface ship programs. For our PMC division, although we see similar levels of revenue that reflect the what has been a depressed oil and gas market in 2021 and early 2022, we believe we're seeing very much the bottom of that depressed market. And whilst revenues have been similar, the profitability in the PMC division has been very slightly improved. For Chesterfield, very positive outlook for the Chesterfield business based on its highest order book for 5 years, driven by major defence contracts. We're seeing a continued strong performance in our hydrogen business as that market steadily expands and grows, with strong revenues there in the 12 months till the period end. And as I mentioned earlier, Integrity Management, our services business that's focused on the inspection and recertification of cylinder systems, almost doubled its revenue in the first half of the year compared to the prior year. In PMC, the order book has grown steadily in the period. We've had a profitable full year now for our router operation, while the Almet operation has, due to the nature of its products, has had a slower recovery, but we're seeing the order intake in that division now continue to grow with a strong expectation from our customers that will continue to do so. So strong second half expected based on the Chesterfield Special Cylinders order book that is well committed and will be delivered throughout the second half of the year. We're expecting continued growth in oil and gas market outlook for our PMC division, and as a result, we remain confident in meeting the full year market expectations. So the following slides then will give you a bit more colour and detail in the financial results, and I'm going to hand over to James to do that.
Thanks, Chris, and good morning, everybody. So this is the group financial results split between Chesterfield Cylinders and Precision Machine Components, and there's a slide just about our banking facilities and net debt position. So the group's position, as Chris has just highlighted on the previous slide, revenue was 9.5 million against 14.5 million for the same period last year. And our adjusted operating loss was 2.1 million compared to the 1.1 million adjusted operating profit in the previous year due to that positioning of contracts through each individual half year. I think the key thing for us is, if you can see on the right-hand side there, that defence revenues continue to be strong. Oil and gas revenues in the bottom right graph, the coloured graph there with the blue, the red, the green and the yellow. Defence revenues in the red still remain quite strong, but that will grow into the second half. Our oil and gas revenues are still at the lower end, but are starting to recover. And again, that should grow into the second half. And our hydrogen revenues, as you can see in the green, are starting to become more prominent to the group as a whole. In terms of net debt, our net debt position at the end of the year was 5.4 million compared to 4.9 million at the end of the previous year. So despite that large loss in the first half, our actual net debt position only moved by 0.5 million. At a more detailed level from the P&L perspective, just to show you that split of revenues and operating performance between each division, effectively just focus on a couple of key things there. That the lower CSC position against the previous first half of 0.3 million operating loss compared to 3 million operating profit in the first half of last year was driven by that contract activity and milestone placements. That will benefit the second half of this year, so that will look different at the year end. For PMC, the operating loss, as Chris said, was slightly improved compared to the previous year for the same level of revenue. And we expect to see that higher performance in the second half as well, as we start to see OEM customers reporting improving outlook for the second half of the year. If I flip on to the next slide, which is about the balance sheet. Key thing on here, talked about net debt already, the 5.4 million net debt compared to 4.9 at the year end. So we've reduced our facility borrowing down to 4 million in the first half of the year. Right of use assets and asset finance leases are obviously we're reducing those over time, so that's come down to 2.7 million at the half year, and our cash and cash equivalents was the equivalent of about 1.3 million at the half year point. We do hold just over 12 million of tangible assets, predominantly tangible fixed assets, as you will know that we've written off in the prior periods into previous years our intangible asset base down to just over 0.2 million. Our net working capital position was about 7.6 million at the half year point, and we expect to see that at a similar level at the year end. In terms of Chesterfield, as we've talked about, reduced revenue down to 6.3 million from 11.3 million, and an operating loss in the first half of 0.3. I think, as Chris said before, the key thing there, the order book at the end of March 2022 is 14.6 million compared to 8 million at the same time last year. So there's been a big change in order intake, which will then facilitate that growth in revenue into the second half of the year. And as you can see there, its gross margins are still fairly consistent at about 29% with prior periods, but for the first half of last year, it was uplifted because of that increased performance and profitability on the defence contracts that went into the first half of 21. As I say, second half of this year for Chesterfield should be a different second half, with the weighting of all those orders being placed into the second half, and we expect to see a good performance at the second half of the year. For PMC, as we said, the revenue and the loss were consistent. Revenue to the prior period of 21 at 3.2 million, and just a slightly improved operating loss of 0.8 million. Again, the order book at the end of March for PMC was 2.2 million compared to 1.6 million at the same time last year. So that order book is definitely improving, and we anticipate growth into the second half of the year. The other key thing for PMC this second half is that they will be doing some operational work on a particular line of defence works with our Chesterfield Cylinders division, and that should start to see that diversification of revenues away from oil and gas into the second half. And on the graph at the bottom there, you can see where it's got a slight yellow bar above the dark blue. That's the industrial revenues that we're expecting to grow over the next 6 months and beyond. But for the moment, that still remains around 10%, 12% of our business in the division. And if I just move on to the net debt position. So in the quarter, in the half year, sorry, as I said, that we've got 4 million drawn debt now. We extended our bank facility with Lloyds Bank through to September 2023. So that lasts for another 18 months as of the half year point. From September 2022 quarter end, so this last quarter that we're just starting now in July, the previous tests of leverage test, which looks at net debt compared to adjusted EBITDA, and our interest cover test that were there in prior times, they returned to us in this last quarter of the year, and we're not foreseeing any issues with that covenant test in this last quarter. Going forwards, that will continue through to the end of the contract at the end of September 2023. And on the right-hand side there, just showing you that split again between net debt between cash and cash equivalents, bank borrowings, asset leases and right-of-use leases, being that 5.4 million as we experienced at the half year. We anticipate that reducing through the second half. And I think that was me done. Chris, I'll hand back to you if that's okay for your operational highlights.
Thank you very much. Great. Thanks, James. Great. So we're now going to get a bit of detail on the two operating divisions. We're going to start with Chesterfield Special Cylinders. First of all, we're going to look at the highlights for the first half of the financial year, and then importantly, we're going to cover two exciting growth areas of the business: hydrogen energy and the various elements of that and its outlook, but also our integrity management services. So our strategy for the growth and development of Chesterfield Special Cylinders back in 2019 was very much about the improvement of margins and operational performance for our core defence contracts, but also for the diversification into new sectors, and hydrogen is an exciting diversification, exciting development for the business. I say diversification, but actually Chesterfield Special Cylinders has been involved with hydrogen, pressurized hydrogen storage for over 70 years, but nevertheless, with the increasing adoption of hydrogen in the global energy mix, there is a very exciting opportunity. So strategically very important for the group. And our other element, core foundation of strategic growth for Chesterfield, was integrity management services, a business started in 2016 that takes our product focused business into new areas of services and recurring revenue and deeper relationships with customers. So we'd like to explain a bit more about that. So first of all, then, the highlights from the first half of the year. Some of these points we have already covered, but a bit more color here. As we explained earlier on, the first half of the year and the second half of the year and the very significant difference in performance in first and second half is driven by the placement of contracts for major defence. From major defence projects, and also the milestones for the delivery of those contracts. And these are things typically that in Chesterfield Special Cylinders we're unable to influence very significantly. As you can imagine, these are defence new construction programs for submarines. The surface vessels are established over a decade before, and we have one small but important role to play in providing the pressure systems, the cylinders for the various systems on board these either the strategic deterrent nuclear submarines, conventional submarines, or surface vessels, not just for UK Navy but also for overseas Navy and for submarine constructors who export those to NATO friendly navies. So very significant. So now these were anticipated order placement timelines. This wasn't, as it has been in previous years, delays or unexpected phasing of contracts. This is the expectation that we had at the start of this year, a very heavily weighted second half. And that will, it drives the order book James mentioned earlier on, so over £14 million, and a significant portion of that will be delivered in the second half of the year. And typically, our defence contracts are the highest value, the highest margin, and therefore have the highest contribution to overall profitability for the Chesterfield Special Cylinders division. And that division has its highest order book for over 5 years. That's the bringing together of several major UK defence contracts, the Dreadnought submarine program, where we're supplying systems to BA Systems. We're also supplying cylinders for Naval Group for their domestic Navy conventional submarine programs for Barracuda. So those are sort of dominant contracts for us. But our defence order book also contains significant orders for our integrity management services business for the inspection recertification in situ of cylinders on nuclear submarines and surface vessels. So significant fluctuations in the first half compared to 2021, but a very significant recovery of revenue due to those milestones expected in the second half from a firmly committed order book from those customers. We've seen strong progress as well in the hydrogen sector. Bit more detail on that in the following slides, but 2.4 million pounds worth of revenue in the 12 months to the end of April. That was only £500,000 in the period before that, and integrity management performance strong as well. So as I've said, strong second half performance expected from Chesterfield Cylinders with more than £11 million worth of revenue already in the order book for delivery throughout the second half. Good pipeline of hydrogen energy opportunities for established and new customers, not just in the UK and Europe, but now overseas. And we have not only the hydrogen demands not only coming from refueling station contracts, which was the early stage in development, but also from large scale green hydrogen storage, and we're seeing that dynamic change in the hydrogen market. It's a strong outlook for the second half of the year based on defence, hydrogen and integrity management contracts. So then a few slides on hydrogen energy, and a little bit of detail on orders, inquiries and developments in that space. So we saw in the first half of the year, order placement was slower than we had anticipated, and I think the several contributing factors to that. Our cylinders are not the only component required for refueling station contracts. Chillers, compressors, and various other components. The lead time on those components were affected by global economic conditions, and also, of course, the increasing costs towards the end of calendar 21 and the early part of 2022. So the pace of the development and production of the refueling stations certainly was slower than anticipated, slower than our customers anticipated, and therefore the ordering of storage is probably about 6 months behind where we anticipated it might be about a year ago. But nevertheless, those plans for those customers are still very strong in terms of the construction and rollout of hydrogen refueling stations for heavy duty trucks, for buses, and so on, very much in line with the overall market direction that we've talked about in previous presentations. But we've had several orders in the first half, orders that we're either working on or have been placed for our customers Shell, Haskell, and McPhee, and that's been based on our successful 500 bar medium pressure storage. But we're seeing other developments and demand for hydrogen storage solutions, which I'll talk about next. It's not just been UK and Europe for us, it's also we have secured our first contracts in Australia and New Zealand, and we're also seeing not just the demand for the static storage, but also the demand for the transportation of hydrogen from the offtake of green hydrogen production through electrolysis through to the end use, and whether that end use is for refueling or whether it's for decarbonisation, that the pressurized storage, either static or for transportation, is very strong growing market, and Chesterfield Cylinders is well positioned to supply solutions for the mobile and static storage of hydrogen. So as a result, we focused our efforts on the development to meet the solutions that customers are looking for. And back when we launched our 2020 December 2020 fundraising, we talked about the development of mobile trailer solutions for hydrogen transportation, and also the development of very high pressure storage solutions, the ability to store more hydrogen molecules in a smaller footprint by the use of significantly higher pressures up to 1,000 bar, and those are the areas where our research and development team, our business development team, are working at the moment with customers to define the steel and composite road trailer solutions to meet the demand for the transport of hydrogen from offtake to point of use, decarbonisation or refueling station, and also the ultra high pressure ground storage up to 1,000 bar, which we're seeing increasing demand for as a result of the anticipated growth in heavy duty truck demand for hydrogen at significantly higher pressures, around 700 bar. So we're expecting through 2023 and 24 for 1,000 bar to become more common, and we're also expecting in 2023 and 24 to see the demand for road trailer solutions in the UK and Europe increasing very significantly. So that's orders, inquiries, and developments. So far for Chesterfield Cylinders, refueling station projects have been our core projects, and we've been focusing very much on the strengthening of customer relationships, which gives us greater forecast visibility. It also gives our customers, of course, the confidence that we have the capacity and the relationships with our suppliers to deliver their outlook. And we've seen, at least in just taking two examples, our customers McPhee and Haskell are significantly through 2023 significantly ramping up their production capacity to meet the demand for hydrogen refueling stations, and they have an expectation on us to be able to meet that demand and the supply of hydrogen storage, pressurized hydrogen storage, to meet their lead times. And typically lead times are significantly shorter than our defence contracts, and the volume of cylinders are likely to be higher in the long run. And you can see our outlook. This is the outlook we have shared with you before. That's not changed. The outlook for bus and truck refueling station demand over the next few years is set to increase very, very significantly, and we are well developed in our relationships with customers to get the best view, then granular level, bottom up, their forecast visibility, which makes sure that we can meet their demand. Of course, we've had to make sure that our relationships with the very significant steel suppliers, Tenaris and Vallourec, are also strong. We've talked in the past about the strategic cooperation agreements we have in place with both Tenaris and Vallourec that make sure we have access to and the supply of the core products for the storage of hydrogen, and so that's been important, and we've had to demonstrate that to our customers, which we've done. Standardizing designs has been very important. So the use of standard designs allows our customers to develop their solutions with their end customers, end users and operators very efficiently, and the development of straightforward supply agreements and commercial terms has made much more efficient the contracting process with those customers. So good progress with refueling station projects, but refueling stations not the only component of our growing hydrogen business. We're seeing increasingly now the outlook for green hydrogen really coming into play, and this is, for those of you not so familiar with this area, this is about the pressurized storage of hydrogen created through electrolysis, either through solar, wind, wave, and other means of green energy. Significant commitment from the UK government and from the European Union to ramping up significantly the production of green hydrogen. And for us, that presents several opportunities. Not all of that hydrogen will be stored at high pressure. Some of it will be stored at low pressure. Some will be through pipelines. Some will be through liquefied storage. But we anticipate that there will still be a very significant demand for pressurized storage, and that storage then will be taken off the green production for its industrial decarbonisation and refueling station contracts. So it allows Chesterfield Cylinders to extend its value across the full supply chain for hydrogen from the point of generation, storage, through road transportation, and then through at the point of use in industrial decarbonisation and refueling station projects. And for those projects, we've just started one of our first projects, collaborating with other end users in looking at decarbonisation projects and how storage is used within those projects. A BASE funded project, which we're starting very soon. So that was our hydrogen. A couple of points on hydrogen. I'm now going to talk a little bit about integrity management services. Not an area that we've given much detail on in the past, but I'm pleased to give here a bit of the history and also the outlook. So it's always been a focus for growth since 2019 for Chesterfield Special Cylinders. It's been a part of Chesterfield Cylinders business that has been actually growing since 2016, based on very strong established credentials of the specialists in Chesterfield Cylinders for naval, submarine and surface vessel inspection. That's the inspection of cylinders and pressure systems in situ on board while the vessels are in dock, using codes and standards that Chesterfield helped to develop, internationally accepted codes and standards that Chesterfield helped to develop. This obviously helps maintain operations, avoids the extremely complex and costly and sometimes impossible removal of cylinders for factory inspection and testing. It's now integrity management services around 10% of our revenue, and is no longer exclusively from defence contracts. It's also from oil and gas contracts, so diving support vessels, offshore oil and gas applications. We've just secured very recently contracts with major offshore operators for their offshore production and drilling facilities, where again we will inspect in situ and help recertify the pressure systems on board. Those pressure systems typically used for motion compensation or control of buoyancy for crane operations, and also for diving support vessels, the breathing air systems, the safety critical breathing air systems. So really exciting. And this year we're anticipating record levels of revenue after a COVID pandemic disrupted 2021. I have a slide on precision machine components, and as I mentioned earlier, our growth strategy from 2019 for PMC was very much about the diversification of the customer base. All of our PMC entities, Router, Almet, and Martract, were very dependent on a small number of customers for a very narrow range of products. Our growth strategy was to extend that range of customers and extend the range of products that we're using, bring new skills into the business to enable that diversification, and on that basis then look at alternative sectors to supplement the oil and gas business. So looking at the highlights for PMC the first half of the year, as James illustrated earlier on with the graphs, we really believe that the 2 years of depressed oil and gas market conditions is that period is very much over. We've seen demand for specific products suited to our router operation. We've seen that recovery strengthen over the past year, and as a result, the router engineering operation in Rotherham, very close to our Chesterfield special cylinders operation, has had a full profitable year, very profitable period, driven by the diversification of the customer base, driven by a wider range of products, but those products have been in demand for a year as a result of the re-establishment of CapEx projects, exploration and drilling, the wellbore reinstatement, and cleaning for the restarting of oil and gas production. So there's been that demand for the router operation for a year, and it's been profitable as a result across a broader range of customers. But our Almet operation was affected by lower levels of oil and gas production, and the components that we make in our Almet facility for Cameron, and principally for Cameron, part of the Schlumberger group, and also for Baker Hughes, that was affected very badly as a result of lower oil and gas production during the pandemic, and we've now seen over the last few months the significant recovery of that demand from Cameron and also from Baker Hughes, as their production projects now really start to ramp up, and the demand for those components have increased. And Almet in June had its record level of intake since the beginning of the pandemic. So we're very much more optimistic about the outlook there. And in that period, we haven't just been waiting for recovery. We've spent an awful lot of time and effort in strengthening our operational performance, our quality performance. We're very much rated at the highest level by our core customers, in particular Cameron and Baker Hughes and Halliburton, in terms of on-time delivery, in terms of quality, but also in terms of relationship. And we're very optimistic about that more diverse customer base and the increasing demand throughout the rest of 2022 and into 2023. A much stronger, more sustainable, and more scalable division we have today than we did back in 2019. And importantly, we're anticipating a return to profitability in the second half of the year as the Almet performance strengthens alongside the router operation. So a final slide to summarize here. A challenging first half of the year for the group, driven by the phasing of defence contracts, but a very strong second half outlook as a result of that order book, as a result of integrity management and hydrogen energy projects coming through, plus the anticipated steady recovery of our PMC business throughout the second half of the year. And notwithstanding those challenges that all businesses are facing today in terms of supply chain, in terms of labour, availability, cost base, and so on. The board, we're excited very much about the opportunities in hydrogen, integrity management, recovering oil and gas markets, but we remain confident in meeting the full year market expectations. So Mark, thank you. That was the end of the slides, and of course we now have some opportunity to answer questions.
That's great. Chris, James, thank you once again for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But as well, Chris and James take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Chris, James, as you can see, you've received a number of questions throughout today's presentation. So firstly, thank you to everybody for their engagement this morning. Perhaps if I may just hand back to you just to read out those questions and give a response where it's appropriate to do so, and I'll pick up from you guys at the end.
Sure.
No, thanks, Mark.
Thank you, Mark.
Yeah, no problem at all. So, Chris, I'll read them out, and then if between the two of us, we'll give it the answers if that's okay. So,
we've got the first one there from George, haven't we?
Yeah, George. It says, "What are typical milestones in a defence contract that will drive performance improvement in the second half?"
Yes, thanks, George. So there are a couple of things to talk about when we look at the phasing on defence contract. First of all, it's the order placement, and the order placement comes in phases in itself. So we'll receive part order for what can be very significant raw material. So the raw material tube that we use is a very specialist tube, very special alloys of tubes. So we'll typically have a milestone that is based on the ordering of raw material, which we'll then receive onto our site, and we then start the process of inspecting that material, checking its thickness, its tolerances, and so on. And as you might expect, given the nature of the product, our customers are heavily involved in that. So the milestone will be based on the receipt and confirmation of quality of raw material in the first instance. The next milestones are then the processes by which we forge the cylinders. We heat treat those cylinders, and then we set about the process of assembling them, adding the necessary fittings, and of course the various testing phases. And the milestones are configured around those manufacturing processes, and also the inspection, testing, and witnessing and sign off by customers. Now we have visibility of those. Whilst we're not in control of when the contracts will be placed, we do get good visibility once the contract is placed about when those different milestones will fall, and that's why we said we're confident in the second half that those milestones, which the milestones do then generate revenue and profit and our ability to invoice, we have that visibility in the second half, and that's what's driving it.
Okay, thanks, Chris.
I hope that addresses your point, George.
This was a pre-submitted question. How are we coping with raw material price increases?
Yes, I think. Well, I mean, every industry is facing price increases across its supply chains. Raw materials are a very significant part of our total cost base, and a very significant part of all the contracts that we're working on, in particular in Chesterfield special cylinders, but also in precision machine components where we're using advanced alloys. We started to see the rise in raw material costs throughout the second half of 2021, and then of course very sharply during the start of the Russia-Ukraine conflict, driven in part by the shock to nickel prices and so on. So a bit of detail there, but yes, nickel is a very significant component in our cylinder tube manufacturing, but also in our advanced alloys in PMC. So how are we coping with that? Well, the important thing strategically is to have strong supplier relationships, so that we're not just at the end of a process that says, well, this is the price, take it. And of course, over the last 2 or 3 years, we've established strong strategic supplier relationships with both Vallourec and Tenaris. We are seen by them as being strategic customers, in which case it is we've been able to get good visibility and I believe fair pricing from those strategic suppliers. Ultimately, our intention, where we can, is to pass those costs on to our customers, either through variations in contracts or through the initial pricing. And typically, we will price contracts in a dynamic way, taking into account of raw material costs at the time that we bid the work to the customer. So in effect, we're passing on those costs. Now our customers, of course, then have noticed that prices are increasing, and we've seen, in some cases up between 30 and 45% increase in raw material costs for steel. But our customers have been very supportive. We've been very transparent and open with them about the way in which those costs have varied, and so far, we have had good understanding from customers when we're passing on those costs.
Okay, thanks, Chris. Okay, the next question was also pre-submitted. Are you happy with the size and quality of your hydrogen sales force?
Yes, I'm very, very happy with not just the size, but the personalities involved and the quality of the team. It's been an important area for growth and development of the business. It was a commitment in 2020 that we made to strengthen and have a dedicated hydrogen business development sales force, and that's what we've established. As you might expect, the sales process for hydrogen, it's not a transactional sales process. It's a very technically driven sales process. Understanding the technical detail of the customer requirements, their operational requirements, is very, very important. So actually we have a good strength of technical knowledge and experience, both operationally and in detail technical cylinder design within the dedicated hydrogen team. Not to say that we know we won't need to expand that in future. We are looking at the moment at how we cover other regions, how we cover Europe more effectively, how we cover other regions more effectively. But today, very happy with the size and quality of the hydrogen team.
Okay, thanks. Okay, another pre-submitted question. Are oil companies beginning to increase capital expenditure on exploration and production?
Yes, they are. We've seen this come in two phases. We saw it start in March 2021, where there was a steady recovery in the in reopening wells in various regions, less so in the North Sea at the time, but several of our customers were actually then starting to engage in their reinstatement of wells and the restarting of some of the capital expenditure projects that had been paused in 2020. That started in March, but it started very, very steadily. At a relatively small scale. What we have seen more recently, since the Ukrainian crisis and the move away from Russian oil and gas, is the restart of significant volumes of land drilling in the US. Also, we've seen deep water South America, deep water West Africa, and now more increasingly North Sea projects restarting. And in fact, some of the abandonment work that was going on in 2020, 2021 has been stopped and reversed. So we are seeing that recovery of capital expenditure on E&P activity. We're also naturally then seeing the OPEX expenditure. So a lot of the components that are used in oil and gas drilling and production are consumable. They wear parts, they wear out, and a lot of our Almet operation, they manufacture the wear parts and components for production in flow control. Those flow control components, we're seeing the demand increasing steadily on the OPEX side, in addition to the CAPEX side. Okay.
Next question is from David. Why was gross margin depressed in half one results? I think that's fair to say that, David, that's mainly around the phasing of defence contracts. They're our biggest contracts, and obviously at our margins that we have for those particular contracts being fairly significant. Any sort of quarter or half year where there aren't major defence revenues to follow with the margin, it tends then that reduced revenues and the impact of reduced margins in other contracts, which aren't as significant as they are with defence contracts. It just means we have a lower performance in that period. But obviously in the second half, we're anticipating a return of better gross margin as we get those defence contracts coming through.
Yeah.
Next
So
question.
Question from Roger on given PMC. I mean, it's a very it's an important question, Roger, about given the delay for PMC to return to profit. What are the arguments for keeping the division rather than selling it and closing it down? Our focus remains to deliver value from the growth and development of both divisions. We put tremendous amount of effort and focus to recover performance within the PMC operations. We didn't feel that was possible for our Quad-Scott operation in 2020 going into the pandemic, and we took the tough decision to close that operation and bring the order book and the customers into Router. We believe very much in the outlook for those operations and the recovery through oil and gas markets. They are better performing, more sustainable, more scalable operations today than they were in 2019, and actually recovering their performance and profitability gives us various options for those divisions in the future. Our focus has been, though, very much to return them to profitable performance in recovering market conditions.
Okay. Next question is from David. Trade receivables increased from 9 million to 12 million. Why was this? That's not necessarily trade receivables, David. That's mainly around our contract assets, because obviously we're working with long-term contracting. We kind of hold a lot of stock and we hold a lot of accrued income and revenues on an accrual basis whilst we wait for contracts to complete. So it's actually mainly around our contract assets in our books rather than necessarily trade receivables. Trade receivables have gone up slightly, but not massively compared to the year end of last year. But the majority of the uplift is down to the fact that we've been working on projects throughout the first half, and then their completions and new projects coming through into the second half as we've ordered raw materials. That just builds up our contract position. That will eventually unwind itself as contracts complete. So that will go up before it comes back down in the future. But yeah, at this point, it was really not down to trade receivables, but mainly around contract accounting positions that we hold.
Got a question from Adrian. And can we have an update on your expected capital expenditure for the remainder of the year and 2023? I just would elaborate. Our principal capital expenditure, Adrian, that we've committed is to our Chesterfield cylinders operation. That was the upgrade of several of our manufacturing processes that we committed funds from our 2020 fundraising to do. That was the upgrade of our shot blast facilities, reconfiguration of our manufacturing and cylinder production lines to enable the long lead time defense contracts to work alongside and not disrupt the shorter lead time, higher volume hydrogen cylinder manufacturing. That capital expenditure has progressed already throughout 2021 and into 2022, and we're expecting that committed capex plan of about 1.5 million in total will complete by the middle of 2023.
Okay. Got a question from Paul about, do we price in dollars, and if so, how much benefit is the weak pound to dollar exchange rate? We do, Paul, but we mainly trade in euros, so there's not a huge amount of significant benefit from the weaker dollar rate at the moment. But the euro rate, as we continue to trade more with our European hydrogen suppliers in particular going forwards, we'd expect to start to build more revenues into euros, and hopefully, if the exchange rate does remain kind of at this weaker point, it should hopefully mean that does benefit us when we convert that money back to sterling, should we need it for our sterling purchases and so forth. But yeah, we don't really do a massive amount of trade in dollars, but we do some, but not very much, mainly in euros.
Good question from Roger about inflation and how inflation is impacting the business. Of course, we covered raw material cost earlier on, but perhaps in some of the other areas of cost inflation, we've seen, in fact, we saw towards the end of 2021, we saw some wage pressure from some very specific specialist roles, which naturally have increased our staffing costs. We've also address general wage levels, as all businesses have had to do, in order to remain competitive across the board for recruitment, but also retention. So we've done that. We've very successfully managed to do that. But of course, it does add cost, and those costs then, of course, do translate into increases in price, or in some cases, lower margins on committed contracts. We've seen around 15% or more increase in our energy costs on site. We are an energy intensive business. Our forging processes use gas, and of course our subcontract suppliers who deliver heat treatment processes also use a lot of gas, and that of course has translated into a higher cost through our supply chain. So yes, inflation has definitely been impacting the business, and where we can, through contract variation and pricing, we're our intention is to recover as much of that inflationary pressure as we possibly can.
And yeah, and in terms of utility costs, we were on longer term deals that completed during this second half of the year. So we may find that our further forward, energy costs may go up, but we will manage as best we can with the deals that are available to us. But I think that answers kind of Nigel's question as well about energy costs. So yeah, we've been on longer term arrangements, but we'll do our best to find the next best rates that we can get when we get to that point.
Yep. So another question regarding regarding hydrogen. So there's a question. What do we see as the key drivers of hydrogen growth over the longer term? And we've presented already now, I think, at our prelims earlier on this year, and again today, our outlook for the hydrogen refueling market. The key drivers for growth in that market, I think it's uncontested that there is a very significant demand for hydrogen in mobility and decarbonisation, supported by UK and European governments, and the US government, very strong support, but also Australia, New Zealand, so very, very strong support in terms of overall market demand. What we see as potentially constraining factors at the moment, though, are the supply chain for the components used in refueling stations. Those are the things that might sort of hold that back. Supply chain in general faces time constraints and pressures at the moment, but I don't think anything's holding back the demand. We see that as being very, very, very strong. But as with any sort of pioneering area or new area, the growth in the early years can be quite sporadic, and we're seeing a bit of that at the moment. But well positioned otherwise to capitalize on this very exciting opportunity, both now in terms of delivering products, but also being able to in the future deliver integrity management services for these safety critical installations, refueling stations and decarbonisation applications.
I think that's it, Chris.
That's great. So, Chris, James, thank you very much indeed. And thank you once again to all those that submitted questions. Any questions that we haven't got through, obviously, we'll make those available to the company after today's meeting. Chris, James, I know investor feedback is particularly important to you both, and I will shortly redirect investors to provide you with their thoughts and expectations. But before doing so, I wondered if I may, Chris, just ask you for a few closing comments, and then I will redirect investors to provide you with their feedback.
Yes, thank you very much, Mark. I mean, we after the 2020 fundraising, we know we significantly increased the investor base for Pressure Technologies, and we're very pleased to welcome so many new investors to the to the group. And using the IMC platform is really important for us to have the opportunity to describe the outlook for the business. A strong second half we anticipate, which is driven by the defence business, but also the exciting prospects for hydrogen business remain strong. James and I are fully committed, as is the rest of the management team, to deliver value from that, and also to see the improving prospects for PMC in a recovering oil and gas market. So nice to be able to share those thoughts and that outlook today. Thank you very much.
Yeah, thanks very much.
That's great. James, Chris, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Pressure Technologies PLC, we'd like to thank you very much for attending today's presentation. That now concludes today's session, and may I wish you all a very pleasant morning. Thank you.